All right, we're going to be talking about the Reserve Bank, the RBA, and a potential recession here in Australia. The last few weeks and months have been pretty hectic in Australia's property market, especially what we've been seeing on the ground here in southeast Queensland. The Reserve Bank's been seeing plenty of heat after doing 12 rate rises over the last 12 months or so. And what is going to happen if they continue to increase interest rates? Are we going to walk into a recession where we have 2 negative quarters of GDP growth here in Australia? And what's going to happen to Australia's middle class and everyday working mum and dads if they've got their own home and if they've got an investment property? And if you stick around to the end of this video, we're going to be talking about interest rates' impact on property prices. The best place I think we can start is where are rates going to head in the next 6 to 12 months? Now, I have to admit myself that I didn't think we were going to hit a 4.1% cash rate. Based on the information we had 6 months ago, what the chief economist was saying at the big banks here in Australia, I thought the cash rate was going to end around that high 3% mark. So around that 3.6 to 3.9%. But given the high inflation that's been recorded here in Australia, sitting at around that 7 to 8% mark and now coming around to the 5% mark, they've had to keep the cash rate higher, and we're expecting some more rate rises this year. So as you can see, we've had these 12 rate rises all the way from 0.1% up to 4.1%. And the next rate rise announcement is only a few days away. Now, I think it's very likely we may get another 0.25% rise. Even though inflation has come down a little bit, I think they'll want to keep the pressure on to keep pushing inflation down towards its target band of that 3% mark. So the big question is what's going to happen going forward? So if we get another rate rise this month, in the month of July, that will be another 0.25%, taking the cash rate to around 4.35%. That means the average Aussie will be paying about 6 to 6.5% on a mortgage. This is 3 times the interest that a lot of Aussies were paying when people were able to fix at around that 2 to 3% band. I know I myself have some interest rates in the high 2%, which have fixed till the end of the year, with a potential mortgage cliff hitting later this year. So the big question for me is, what are the banks now saying based on the rate rises we've had and the information we have at hand? So let's take a look at Australia's big 4 banks. So the big predictions from Australia's biggest banks are CBA saying we're going to have a peak of 4.35% by August 2023. Now, this would mean we would just have one more rate rise, either between July or August this year. So either next week or next month, CBA is predicting another 0.25% cash rate increase. And then they're expecting the rates to drop to 3.1% by the end of 2024. Now, it hasn't said here when that cutting is expected to start, but based on what the banks are saying, that would start in early 2024. And that's assuming we go through some tougher economic times as a country over the next 6 months. Now, Westpac, NAB, and ANZ are all predicting a peak of 4.6% by July and August 2023. So Westpac's essentially saying we need another 0.5% increase by this month, which I don't think is very likely. I can't see the RBA doing a 0.5% increase. We're much more likely to have 2.25% increases between July and August, which would lead us to a 4.6% peak in August 2023. And the really interesting thing here is that both Westpac and NAB are predicting a fall of the cash rate back towards the 3% band by the end of 2024 and Westpac by the end of 2025. Whereas ANZ aren't expecting the RBA to pull rates back as much, and they're expecting a drop back to 4.1% by the end of 2024. So who really cares? What does all this mean in terms of those forecasts of the cash rate? Well, if we hit a peak around 4.35 to 4.6% by August this year, so in just 2 months' time or just under that now, then for the average Aussie, you're looking at around that 6.5% for your mortgage. Based on when they're expecting the decrease in interest rates or cash rates here, late 2024, between 3 to 4% cash rate, we could have a 0.5% drop in the cash rate by the end of 2024 or up to a 1.5% drop depending on the banks. This means the spread, in terms of what the banks are saying that the cash rate might land, has approximately a 1% difference. So we could be sitting around a cash rate of 3%, we could be sitting around a cash rate of 4% by the end of 2024. Now, this isn't a big decline in cash rates. We come up from 0.1 all the way to potentially 4.6%, which is a 4.5% increase in the cash rate. And by the end of next year, they're expecting a maximum decline around that 1% mark into the low threes. So that could be a 1 to 1.5% decline. And if you're ANZ, they're saying there's only a 0.5% decline in the cash rate. The big thing for me, if we talk about a recession, which is just 2 negative quarters of GDP growth, is that it's going to be a technical recession, but I doubt we're going to feel much pressure on the ground. A lot of Aussies have a lot of cash buffers, and if you're in the lucky position to look at buying your own home or buying an investment property, you're likely to be better off than a lot of people. So with the information at hand, we need to make an educated and an informed decision. Now, I can talk about what Emily and I are doing in our current property portfolio. We're refinancing our unit block that we bought in Coffs Harbour, which purchased the property for around $1.4 million, and we're currently working with our mortgage broker to move across the CBA. That will decrease the interest rate for us at around the 2% mark, which will save us roughly $20,000 a year. So you need to look at your own property portfolio, looking at the current cash rate around that 4 to 4.5% mark, knowing that you should be paying an interest rate between, say, 6 to 6.5% for the average Aussie for their own home or an investment property. Work backwards. Calculate your numbers on that 6 to 6.5%, add a buffer of 2 to 3% and look at the worst case scenarios, and then work out what you're comfortable with in terms of your own risk profile. Now, as Emily and I were scaling our property portfolio, we had a much higher risk profile. We put down a small deposit for our first property. We were aggressive with making renovations and looking to acquire more assets because we were willing to take the risk. Now we've got over a $5 million asset base and property portfolio. We're a little more risk averse in managing our assets and having much larger cash buffers to get through these interest rate environments and to do our raise and build projects and to take on other renovations. So look at your own situation, look at your own risk profile, look at your cash buffers and work backwards based on the scenarios we have at hand. Always make sure you've got those cash buffers in place to protect you in case of the worst case scenario and to handle future interest rate rises. Now, the big thing with the Reserve Bank is that I think they get a lot of heat on YouTube, on social media, and from the big media outlets. The Reserve Bank only has one lever they can pull, and that is interest rate increases. So if that's the lever they can pull and use to manage Australia's economy in terms of pushing pressure down on inflation, then they need to increase their cash rate to decrease inflation. A hyperinflationary or a significant inflationary environment is not good for most Australians. So the fact that they've got this blunt instrument and they need to use it is just a fact that we have to all live with at this point in time. Now, when it comes to rates, it looks like we have 2 more to go. And based on what the big banks are saying, they're going to be 2 more in the next 2 months, potentially, at around that 0.25% increase. Now, I personally don't think that the RBA is going to do more than those 2 rate rises. But as we've seen, they've been willing to go above that high 3% mark in terms of the cash rate, which was the expectation 6 months ago. So based on the information in real time, we as investors and homeowners need to make those educated decisions and use the information we have at hand. The third point is around the recession. Now, that is 2 negative quarters of GDP growth, but I think that's going to be more of a paper recession rather than people on the streets. Australians are willing to put housing over food, over lifestyle, and I think what will happen is a lot of Australians will pull back on their lifestyle options like travel, like spending on new cars and on new clothes, pull back on those lifestyle options to protect their investment assets and to protect their own home. Now, the big question amongst all this is what's going to happen to property prices? We've seen another 6 rate rises at the start of 2023, but we've also been seeing property prices rising since December 2022. So even though interest rates have increased the last 6 months, property prices have bucked the trend and also increased at the same period of time across Australia's major capital cities and our regional markets. The big reason this is due to supply and demand. As we're seeing, there's a lot of interstate migration. That's what we're seeing on the ground here in Southeast Queensland. We've got people coming from Melbourne, from Sydney, from even some of those major regional locations coming to Brisbane or Southeast Queensland for living, lifestyle, and job opportunities. The other thing we're seeing here on the ground is overseas migration. There's approximately 300,000 to 400,000 people coming into Australia in the next 6 to 12 months. So based on the volume, and that's going to just continue here, that we're going to have that overseas migration. So based on these volumes, we're seeing more demand come into Australia's market. Coupled with limited supply, because there's a limited number of properties and we can't just flick a switch and add new stock to Australia's housing market, that's why we're seeing property prices increase even though we've had interest rate rises. The most important thing, in my opinion, when it comes to talking about the Reserve Bank, rates, and a potential recession is its impact on you. It's all well and good to talk about Australia's economy and what's going on at that global or macro level market, but I personally care about the impact on myself and on my clients and on you guys as subscribers to the YouTube channel. What is the impact of these changes going to happen on you and your family? How's it going to affect your repayments on your own home and your current mortgage? How's it going to affect your strategy in terms of finding the right investment assets? Do you need to go for growth? Do you need to go for cash flow? Or do you need to go for a mix of both, depending on your situation? It's going to be different for different investors, depending on your borrowing capacity, depending on your life goals, and depending on your incomes and expenses. So the thing I hope you take away from this video is that you can use the information that we have available at this point in time to make that educated and an informed decision. Now, if you want to sit down with myself and have a free strategy session, head over to purposeproperty.com.au to book in that session. We'll sit down, have a chat about your situation, talk about what we do here at Purpose Property, and talk about how we can help you secure an asset here in Southeast Queensland, whether it's your own home or an investment property. I'd love to hear your thoughts about what you think is going to happen in Australia's economy over the next 6 months. So leave a comment down below and drop a like on this video. Click this video over here if you're interested in more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.